Global investment banks like JP Morgan, Bank of America, UBS, and RBS are large participants in these markets. So are mutual funds, which are a pool of public money which is invested across asset classes, especially the largest ones being the equity markets. Hedge funds trade in these assets across the world in different currencies in different countries, using the services of prime brokers, executing brokers across different stock exchanges. In this video, we're going to take a look at the trade life cycle of equities. Many of us are already working in investment banking operations and therefore would like to know more about trade life cycle of equities, also called as life cycle of a trade in equities. This is a video numerically sequenced as the first video on equity series. So we'll be discussing at least 8 to 10 videos on trade life cycle of equities. This is the first of the videos. If you're keen on a career in global markets, especially in investment banking operations, are keen to know more about what stock markets, fixed income, foreign exchange is all about, what are the new interest rates like SONIA, LIBOR, etc., with a focus on operations, regulations, and settlements across 4 dimensions, that is fund accounting, OTC derivatives, trade life cycle, and custody operations, I request you to please subscribe to my channel. I'm a global markets trainer for 14 years and have conducted such trainings for almost all investment banks that have setups in India. Let's take a look at what is equity marketplace that we're talking about. Equities is the second largest traded financial asset in the world. Do you know which is the largest traded financial asset in the world? Yes, it is the foreign exchange market. Foreign exchange trades contribute to almost $5 trillion of daily trades, whereas equities contribute that much in a week's time. Okay? But equity markets are very localized. Unlike foreign exchange markets, which are very global, equity markets are very localized, specific to that country. I've already uploaded a video on foreign exchange trades, the link of which is shared in the comment section below. The top 3 equity markets in the world are the New York Stock Exchange in the US, NASDAQ, which is also based in the US, and the London Stock Exchange, which is based in the United Kingdom. These 3 equity markets, which employ thousands of people as front office dealers, as well as lakhs of people as back office settlements, contribute extensively to the financial sector growth that has taken place in the last few years across countries. The equity market can be broadly segregated into 2 different categories. The primary market, which is the IPO market, IPO standing for the initial public offering. This is the case where a company issues its shares to the general public for the very first time. The secondary markets, which is the second aspect of primary market, is when the securities are allotted to the investors, they get listed on the stock exchange. These secondary markets in equities are called as stock exchanges. If you're working in an STO, that is a securities trading organization, I request you to please use the word stock exchanges and not the word stock market, because markets mean something different. Okay, the exchange is where there is a matching of the buy orders and the sell orders, and the secondary markets therefore take place wherein there is a matching of buy orders and sell orders. So I request you to please refrain from using the word share market if you're working in a global IB operations setup. Please use the term stock exchange or securities exchange. The trade life cycle of an equity is what this video is going to be discussing about, or rather the series of videos is going to be discussing about, comprises of 3 distinct functions. The first one is the front office, the second one is the middle office function, and the third is the back office function. The trade gets initiated at the front office, it gets validated and risk controlled by the middle office, it gets settled and reconciled at the back office, so that the next day the front office can start trading again. So these 3 functions are an integral part of each other. Nobody is more important than the other, because one without the other cannot survive. So it's very important that these 3 functions are well lubricated, in the sense that they work in harmony with each other, so that each entity knows exactly what is the expectations, what are the roles, what are the responsibilities, and the outcome of this trade. In this video, I'm going to specifically talk only about front office function of equity traders. Okay, in an investment banking environment, investment banking operations environment, or in a hedge fund administration environment, the entities participating in a trade are called as STO, Securities Trading Organization. That is the entities who participate in an equities trade. So now let's take a look at what is the job of a front office. What does front office do? Front office comprises of all the dealers who sit in large financial centers like New York, London, Hong Kong, Singapore. Okay? And they deal with clients, large institutional clients like mutual funds, hedge funds, pension funds, insurance companies, etc. They trade on their behalf on different stock exchanges, either through client orders, and then they do the cover operations through the interbank dealing in the market. So this trading, this continuous dealing in securities is the job of the front office. But the front office cannot trade recklessly. They cannot trade in an undisciplined manner, in an unregulated manner, for which they have a middle office function. So all STOs, that is securities trading organizations, have middle office as well. We'll be discussing about middle office in video number 2. So now let's take a look at what is the process flow in a stock exchange trade of an equity. Stock exchanges across the world, like the New York Stock Exchange, the London Stock Exchange, the Singapore Stock Exchange, etc., have registered brokers. Brokers are members of the exchange. These brokers could either be prime brokers or executing brokers. I've already uploaded a video on prime brokers, the link of which is shared below. The institutional investors like hedge funds, pension funds, mutual funds, insurance companies contribute to almost 80 to 85% of the daily volumes on these stock exchanges. Okay, so the institutional investors are the largest investors in any country's equity markets. In fact, even mutual funds in India, even though they have assets under management running into billions of dollars, their money is ultimately coming from retail investors like us. But as an institution, they collectively buy because of the pooling concept. The traders are of 4 types: speculators, those who speculate on price movements of specific equities. They take long positions or short positions and quickly exit their market positions. Arbitrageurs are those who exploit price differentials in 2 different markets. Hedgers are those who are hedging the cash position with a counter position in the F&O or in the futures and options segment. And leveragers. Leveragers are those who borrow money and trade in the stock market. We've heard of loan on IPO, we've heard of share market, loans against shares, etc. These are all leveragers. They borrow money and they participate in the securities exchange. So all these investors and all these traders collectively, okay, participate in such a large volume to the market, making the market a $1 trillion market. So the stock exchanges have registered brokers, institutional investors, as well as different types of traders who trade on it. This is only from the trading perspective. From the settlement perspective, we have depository, custodian, etc., which we'll be uploading videos on separately to understand the role of each of them. The trade flow of an equity trade on a stock exchange is very simple. The buyers place buy orders with their broker. The broker then places the identical order on the stock exchange. The stock exchange is now a trading platform which matches buy orders and sell orders. The sellers place sell orders with their brokers, and their brokers place those orders on the stock exchanges. The stock exchange, which is an automated trading platform, there is there is no human intervention at all in this matching order mechanism. They match the buy orders with the sell orders. So the buyer's counterparty is the buyer's broker. The seller's counterparty is the seller's broker. buyers and sellers remain anonymous to each other. They don't know each other. Okay? So it's very important to know this fact about a stock exchange. Stock exchange is a centralized automated trading platform. Let us understand the concept of a counterparty, because you will see this term very often in a trade slip. A counterparty is the STO at the other end of the transaction. Okay? So in an exchange traded instrument, buyers and sellers are not counterparties to each other. The buyer's counterparty is the buyer's broker. The seller's counterparty is the seller's broker. The brokers are counterparties to each other because they are members of the same stock exchange. So does the stock exchange have any counterparty? Yes, of course, the stock exchange also has a counterparty, which is the buyer's broker and the seller's broker. Okay? So counterparty becomes very important to understand in the context of counterparty default. That is, the risk that the buyer pays, the seller does not pay, etc., is all called as counterparty default. So in an STO environment, it's very important, very critical to understand buyer's counterparty and seller's counterparty. Okay? Buyers and sellers are not counterparties to each other because the transaction is routed through a centralized stock exchange. The different types of orders that can be executed on a stock exchange primarily are buy orders or sell orders. The buy orders or sell orders can come with a price limit. That means a price is mentioned on the order. So what else does the order contain? The order contains what you want to buy, how much you want to buy. If you add a price to it, the order will get executed only at that price or better. Okay? If on the other hand you don't add a price to your trade, to your order, it's called as a market order. Then at what price will the order get executed? At the LTP, that is the last traded price. So the limit orders and market orders, price orders are also called as limit orders. Market orders are called as market orders. They could either be buy orders or sell orders. Okay, so you can have a buy order with a price, without a price. You can have a sell order with a price, without a price. So these type of orders continuously flood the system, and the algorithm that runs the trading platform identifies these orders and pushes it through. Then we have the stop loss orders. The stop loss orders are the reverse of your initial trading position. So if the trader had initiated a long position, then the stop loss order will be placed at a price below the traded price, and if the trader had initiated a short position, then it will be above the traded price. So stop loss is also taken into consideration to reduce the loss of the trading position. So what is the role of the stock exchange in all this? The role of the stock exchange is very important because it issues standardized instruments. Once a company does an IPO, it must get the approval of the securities exchange or the stock exchange on which it can be listed. In return, the stock exchange assigns a ticker, TICKER, to the stock, and then it gets listed. I've already uploaded a video on what are the regulatory requirements of NYSE, NASDAQ, etc. on listing process of the securities, the link of which is shared below. So the stock exchanges issue standardized instruments, which is very important to recognize in an automated environment. The stock exchange also does rolling settlements. Rolling settlement means every T+1 or T+2 is the standardized rolling settlements across stock exchanges. T+1 means trade date plus 1 working day. T+2 means trade date plus 2 working days within which settlement has to take place. So in an environment like a STO environment, functions are segregated according to trading, risk control and settlements. Since settlements take place every day for the previous day's trades, it's called as a rolling settlement, as opposed to fixed date settlement when settlement takes place on a specific date. Because of the presence of a large intermediary like a stock exchange, the counterparty risk is significantly reduced in a stock exchange. So this about sums up the role of the front office in a life cycle of a trade, of a STO. Okay, we'll now take a look at the middle office functions in the video, which is numbered video number 2. Thank you so much for viewing this video. If you have any queries, please post it in the comments box. I'll be more than happy to receive feedback, and do suggest topics that you might want me to cover on trade lifecycle of equities. Thank you so much.